All right, so welcome into the live stream today. We, of course, will be covering the FOMC meeting, what could be the biggest FOMC meeting for the markets that we've had in the history of the markets out there. So everybody's watching. My name is Paul Barrow. Welcome back into the show. I want to thank our sponsor today, and that is going to be Coinbase. And of course, you guys can join over on Coinbase.com. Very easy to set up an account over there. And if you're brand new to crypto, which is quite a bit of you out there right now, we're getting a lot of new viewers. So if you haven't set up your crypto account and started trading, go over to Coinbase.com. You guys can, of course, get going on all of that. We are going to get going on all of this today. There's a lot happening when it comes to what's going on with the Fed. And one of the things that I want to focus in on, and the biggest issue, is really around what's going on not only the Fed's position of whether or not we cut a quarter basis points, whether or not we cut 50 basis points, all of that right now is really kind of looming in a big way. And another factor that's going to play into this, I think, is, and by the way, we're going to get into some questions today, so make sure and leave some of those over there in the comments. We'll try to get to those the best we can. I'm going to try to get into a tab or two here if I can get our response monitors to get going here, and we'll get started into that. Hopefully that will happen. If not, I may have to quit that and go into a reboot there. Yeah, let's go ahead. Yeah, let me go into our first clip real quick, because I think one of the things that I want to play into is some of the strategies that many of the analysts are starting to look at. And a factor that you have to consider right now is, because there's kind of this back and forth between a quarter basis and a 50 basis point. Can we go to that first SOT 1?
What does the market need? What does business need? What does the economy need?
The neutral rate today is 2 3/4 inflation plus 0.75%. I think it's probably the real Fed funds rate, the real neutral Fed funds rate. That gets you to 3.5%. I think it's hard for me to argue it should be lower than that. So at 4 1/4, 4.5, Fed doesn't have that much room. It's got 75 to 100 basis points. And so the reason I think the Fed will take it one meeting at a time, will be careful about committing, is one, these cross currents, the fact inflation is running well above target, and also the fact, I think with inflation above target, you could argue being somewhat restrictive, but I think it's harder to argue you want to get all the way down to neutral. And that tells you the Fed has about maybe 50 to 75 basis points of rate cuts to work with, unless the economy weakens a lot or inflation improves meaningfully from where we are.
That would be a good reason not to go 50 basis points today.
Right.
Go 100.
That was an interesting statement right there. Go 100 basis points. So I don't know. Do you guys think we are going to be in a position where we get more than a quarter basis points? Because I think this is a factor that could have a lot of a bearing going forward on just in general what's happening around the Fed rate cut. And I do want to get into a couple of points real quick. Let me just jump over to my screen. Hopefully we'll be able to bring it back in. And it looks like we are not going to be able to do that. So let me get to this real quick. Let's go ahead and play this next clip, and I'll respond to that one while we get this picked up.
Look, I mean, credit markets are extremely bullish at this point. And you could argue that, well, part of that is that we have multiple rate cuts priced in. But if you go back to 1 year ago, when the Fed went into that September meeting and cut by 50 basis points, financial conditions, credit market conditions are actually easier now than they were 1 year ago. And inflation on a 3-month annualized basis was very close to 2% a year ago. Now we're closer to 3%. So you have easier financial conditions and higher inflation today than you did a year ago. And so in my opinion, I actually think the case is less persuasive for the Fed. Certainly 50, I think, would be totally inappropriate, but even 25, I think that they could end up delivering a message today that disappoints markets a bit if they don't flame those expectations, which are for rates to fall 140 basis points or so over the next 12 months. That seems a bit steep considering the financial backdrop here.
All right, so I think this is one of the things that we are facing right now is there is a lot of expectations built around what could be people expecting a 50 basis points or maybe even multiple cuts here in a very short period of time. So that's my concern right now, is that there might be high expectations, and how the market comes off of that is going to be pretty critical. So when you look at that, along with what we're just seeing in general, I think that one of the big factors that plays into this is where we are right now on just inflation. Of course, if I bring up truflation, this is another factor that the Fed, of course, is dealing with, and that is how do they balance what's going on with inflation, which most likely will be, I won't say hyperinflation, but I anticipate we're going to continue to see ticks upward. And if you look at it right now, all the way back here to April, let's pull that, 120, it was like right at 1.22. It has been on a slow pace up here over the past few months. So I guess the real interesting point right now that Chair Powell is facing is watching that occur when it comes to inflation, and then at the same time seeing all of these jobs reports in terms of these just massive revisions coming out of the BLS. That all of that plays into where we're dealing with right now, which I think is whether or not we see a pump or a dump in the market. And going forward, here was Lark Davis, says the FOMC, of course, 2020, every September, FOMC, except during 22, bear market, had set Bitcoin up for a massive pump. And this is regardless of whether the Fed cuts rates or not. It's less about the decision itself. It's more about seasonality. Bitcoin thrives in these stretches. Now, I would say this is, I'm not really into cycles other than, when you look at liquidity cycles in general. But right now, what we're dealing with, I think, is a much more economic pressure in general around how consumers are responding to this. And this goes back to my theory that I've been talking about here on the show quite a bit. And that is this cycle going to be the haves versus the haves? And what I mean by that is, in general, you look at where Bitcoin has been, you look at where the market is right now, and the fact that we're seeing such institutional adoption and all of those kind of issues playing into it, I think it's still in a position right now where we are not really seeing retail coming in. And the factor that plays into this is the fact that we are not seeing the kind of activity on a lot of the, whether you look at some of the altcoins, we haven't seen altcoin season necessarily adopt or respond the way that we had anticipated. All of those kind of things are factoring into this. So it is still a big deal. All right, so it looks like the number is in. It is going to be a quarter basis point rate cut. So just if you're brand new to the stream right now, the Fed has announced it's going to be a quarter basis point. We are waiting for Chair Powell to come on, and this will be a very significant statement and response to the press corps. Probably the biggest one he's done yet, because the pressure coming in from Trump and the administration, and also what we're seeing about both sides of the market. What I was getting at there, where you have inflation raising up a little bit, and if you go back to truflation, remember this chart right here, slightly going up to 2.29, looks like we continue to rise a little bit in reality, almost weekly. And I think this is a factor that will continue to put a lot of pressure on Powell. I'm surprised that we only got a quarter, but I anticipate that one of the reasons for that is they're trying to adopt, or I should say digest, more data coming in on that. If you look at this statement right here, when the Fed rate cuts with stocks within 2% of record highs, the S&P 500 finished the next 12 months higher every single time. And then 20 out of 20 was the win rate. So pretty significant right there if you just look at the next run on the S&P 500. So this would say that it's bullish for stocks. It's likely that it could be bullish for risk assets because of the nature of what's going on with inflation and jobs. So you've got that double-edged sword that a Fed is essentially having in terms of a dual mandate, and that is try to pre-position what's happening in the job market, but at the same time deal with an inflationary situation from an economic standpoint. So all of those things are playing out right now. It's the worst possible case for Chair Powell, and I think because of that, we get into some issues that many people would say, well, this is why we didn't need a 50 basis point rate cut. We need to see how the data responds. And I think that's the real question. The other thing that plays into this is where we get into history. And let me go to this one right here. If you look at how it's been in the past, small stocks outperform when the Fed starts to do a rate cut after a long pause. And that's what we've been in, longest pause since last September. Remember, that was a 50 basis points. So this is the first one we've seen in a year. And going into a cycle that we're losing jobs at the pace in which we're losing them. So I think this is where risk assets start to play into. And if you think about small stocks, mid caps, et cetera, that has a lot of similarities to the crypto side of things when it comes to what's happening in the altcoin market, but also in some of the other performers, even in the blue chips out there. Other things you got to look at within this. There's a few things I agree with in this article. Somewhat unique characteristic of this cycle has been the elongated nature, which we talked about earlier. Long pause since the last rate cut, that was December. And then returns following rate cuts have been coming after a pause of at least 126 trading days. That's the encouraging part. Market split on short-term reaction, and I think this is the real question mark. And if we go over to the chart, let me go over to, let me see if I can pull up, let me pull up a chart for you guys real quick, because this is going to be interesting. If we go to the short minute, let me go to the 5-minute chart right here on Bitcoin, and we'll take a look at how it's responding to the early call right now. All right, here we go. Let's zoom in on this one. So looks pretty good right now. You see a little bit of a retracement, but I think the question is how does this perform over the next week to 10 days, especially as the data comes in from jobs, core CPI, and what we'll see in Powell's remarks to the press today. Because this is the real question now that we know we have the quarter, is now we're setting on a position where we got to understand, is he ready to really receive information differently to save jobs? Because he's got to pick one. You can't do both. It's likely that either inflation is going to continue up. The question is can he thwart the job loss? I still believe that's going to take a few months, possibly a full quarter into early next year before we'd start to see that kind of response. And again, still on the 5-minute candles, 2 green candles right now on Bitcoin going up. Let's take a look and see what Ethereum has been doing. Of course, that big retracement right there and back above 4,500 right now as we are recording this and going live. Again, if you guys are not part of our Diamond Circle, I want you guys to jump in on that. It is our free, we always leave a link down in the description, but it's our free newsletter. It's one that I write out to you guys and the team every week. I send out, here's what I think is happening. A lot of this is compiled from our current research. So a lot of times we can't get all the research here on the show. We try to get that out to you guys in a follow-up. And also it will give you a little bit of an insight on where I think the markets are heading around all of that. Let me go over to this whole theory that I have, and this is the haves versus the haves. And I've been talking about this. Here's Lisa Abramowitz coming over from Bloomberg. She says, hey, consumers in the top 10% of the income distribution accounted for 50% of U.S. spending in Q2. This is up from 48%, okay? I know those aren't big, variables, but when you look at 50% of the market and where it's setting, that's pretty significant. That was in Q1 and reaching its highest level in data going back to 1989. Okay, so many of you guys probably weren't even alive in 1989. So that's the kind of impact that we have not seen from the top 10% carrying an economy. This is the thing that gets me into this cycle. And if you have the haves versus the haves, and it's a real number, unless we get into something that I feel may be an opportunity for a younger audience and people that are more meme and or altcoin oriented, is they're going to start to see the inflationary pressure. That could push them into risk assets quicker and away from what we've seen in the past, which is, hey, let's try to figure out how to go buy real estate or other kind of assets like that. So I'm in agreement in the sense that this issue right now that we're dealing with around the haves versus the haves, that's where I think a lot of the blue chip tokens are going to be traded. So look for that top 50 to be the ones that probably end up with the most volume. Typically, that's obviously the case. But do we get an outlier that starts to make a run in the top 50? Let me know in the comments of what token or series of tokens that you guys think will be coming in. And I know we're going to get to some polls as well. I don't know if the guys have put up a poll yet for you guys to kind of go in this direction. But This is the point I'm getting at. This is the housing data right here. This is renting, which is now significantly more affordable than buying a home. So by one of the biggest gaps ever recorded. And this is a big one because, again, it goes back to the point I'm getting at around the issue with new investors coming to the market. They have to make a decision now of where do they put their money. So you can either say, all right, I can go into something like gold and silver, which is barely going to, maybe not going to move as much unless we see a debasement acceleration, or I can go into Bitcoin and Ethereum. Maybe I don't see the kind of run that I'm looking for, or I can go ahead and jump into these, in this particular case, altcoins, which are the mid-cap kind of concepts behind that. That's where it gets interesting, because that's when you have a market that I think could flip to the positive side for altcoins. And this is a good example. Eric Trump calls crypto the perfect hedge to real estate assets. And that's the concern I have right now, is that the American dream has been changed. The American dream now, I think, is digital assets. And that's coming from the under 30 crowd, maybe even the under 35 crowd, that have either abandoned the idea of owning a home and understand that they're going to rent. Many people in the top 10% believe that is the strategy, is that you should never put money in those kind of assets. You should be looking at either cash flow assets or looking at dividend assets, or in this particular case, assets are going to be able to appreciate in value. And that's the whole point around risk assets that makes this really a good position, I think, right now for the market in general. We're going to get to some questions. I'll try to get into a few of those. Let me view the queue and see what they got in the queue here. Let's go to, all right, so let's see if we can get a few questions in here. Looks like imagine the hike. Everybody's looking for like a 50, where it's going to go from here. I think that's going to be the issue right now. Let me view the queue. All right, well, maybe they're going to send me some questions here in a minute, because I'm seeing the queue come in blank. Other things that are playing into this, and as a reminder, if you just joined the live stream, we have a quarter basis point coming in from the Fed. So as anticipated, that was like the 90% odds on what was happening over on poly market. And I think the big question right now obviously goes into the next layer. There's the quick rundown. People are still looking at three cuts now at 60% odds for the rest of the year. That would look pretty solid for the market, I think, in general. And we may find that out today. So stick around for this, because we will go to the Fed here. They go on about 2:30. He'll come in, he'll start addressing the press corps. And one of the points behind what we're getting at right now is when you look at the three cuts, 25 basis points each, playing into this, because I don't anticipate an acceleration. I guess the key here will be two things. One, CPI data coming in, how the jobs numbers come in on the next report, because if we continue to see that loss, that would be a problem. And that, of course, could flow into maybe a more aggressive cut cycle. I don't know just yet, because again, we'll see how Chair Powell reviews how they're looking at the data right now. And it's very possible they may already have some early data. Because remember, the BLS is trying to accelerate how the data is being delivered to the Fed. So that in itself could change a little bit of the course of action here for Chair Powell going forward. But a big spike right here on 25 basis points coming up. And of course, the two starting to slide down. So maybe it is just the fact that we saw the quarter come in and we feel confident that we're there. Is this a sell the news event coming in from Commandal right there? I don't know that it is. And two ways that this could go is, if you look at the situation right now where Bitcoin is holding steady currently. Now, of course, everything will depend on what Chair Powell says in the actual press conference. But if we start to see a little bit of movement in Bitcoin and Ethereum, could it be a short-term issue? And I think that's maybe more of a scenario. If you guys are a trader, maybe that might give you an entry opportunity, or at least a chance to maybe even do a short if you wanted to. But I'm looking at this beyond this. And when I say that, I'm looking at mid-October. What does this look like? What does this look like in the November meeting? And then what do we see at the end of year? Because this is all really narrowing down, I think, to some very key times in terms of how this plays out. A couple other things I want to get into is let's go to the government shutdown. Let me pull this up real quick, and then we've got a clip on this as well. So the government shutdown, this is an issue right now that is being faced. Again, this is a little bit more bearish for how the markets might respond, but policymakers basically have until midnight, September 30th, that's just around the corner, to be able to set this up. And I've got a clip of Mike Johnson talking about this. Let's go to that clip real quick.
The Democrats want concessions on health care, I guess Medicaid or something that was in the BBB. So if you don't do what they want, you are responsible for shutting down the government. It's totally Republicans' fault because you're not doing what Jeffries and Schumer want you to do. So it's obvious that it's Republicans' fault.
Yeah, you framed that exactly right. Here's what's happened. We have been trying to force the government appropriations process back to what we call regular order, you know, the way it's supposed to work. That's what's happening here. What they're trying to argue for, not to get too deep in the weeds, is they're trying to insist that the Obamacare premium subsidies be continued. That's a December policy debate and decision, not a September funding matter. So they're trying to insert unrelated matters into the middle of a clean government extension. And I don't think that's going to work. If the government is shut down because they make that their last stand, it will solely be blamed on Democrats, because we're not playing politics with this at all. We're just trying to keep the lights on.
All right, so that could be a little bit of a concern right now going into the latter half of this year. If we get any kind of shenanigans, my guess is that, like most of the cases, our corrupt politicians will do what they do, and that is they do deals behind the doors. They put together something that, you know, gives this guy that and this guy gets that, and you end up with a deal at the end, and it'll be at the last minute. And of course, there's going to be all sorts of situations that play into this that probably will not be good for whatever project is being dealt with, at least at that voting block time. But for the markets, I think the key is just keep it into a position that is positive, where the S&P continues to see strength coming in from the administration. That's the key there. One big news item that just broke around the issue of this quarter basis point. The Fed approved quarter-point interest rate cut and sees 2 more coming this year. Now, this is based off of what was right now an 11-1. Let me see if I can zoom in on this for you guys real quick. This was an 11-1 vote, signaling less dissent than even Wall Street had anticipated. So it looks like, guys, this may be the turning point for what we see in the market. And if this is what everybody is waiting for, whether it is people coming off the sidelines from money markets, remember $7.5 trillion sitting over there, whether it is major institutional capital trying to reposition, family offices, high net worth individuals, trying to figure out, are we ready for this? All of that now looks to be where we could be in the right direction here. And if Chair Powell actually confirms this is not confirmed data. This, of course, coming in from right now from CNBC. I think that would be very positive for the markets, and it could help kind of thwart what's going on right now, you know, at least from Capitol Hill, if we get into situations around, you know, slowing of government. Other things that are happening right now, you've got a lot of money coming into exchanges, which is huge. This will be good inflow. I anticipate this is going to grow significantly after today's quarter basis point, because people want to be ready. So right now, this is going to expect more stablecoins starting to move in, USDC. This will, of course, benefit all the ETH ecosystem. All of that, I think, is going to be good. Rate cut was already baked in. I disagree, Blaine. I don't know that it was. Now, granted, Bitcoin had moved to 117, started to recorrect, but I'm not sure that we don't see a pop from here going forward. If we look at ETH and Bitcoin back to the chart, kind of up and down here on the 5. But I think the real question will play, and I don't know that a lot of people understand what that CNBC article just gave. That was very, very bullish. And if that is true, if Chair Powell comes in and validates what that was basically reporting, this could be pretty significant in terms of how the chart comes in. Jerome should have cut by 1%. I agree with you, Daniel. We are in a position right now where I think playing catch up, unfortunately, is the situation we're in. And, you know, it's going to be one of those things. If we get another 3 quarter basis points this year, at least 2, and then maybe they set back and look at it. Because remember, I think we're still going to be in for higher inflation at that period of time. But the key is, did we thwart any of the job loss that are now coming into this? So that in itself is a big deal. Let me load up a couple other topics here that I want to get to. Here we go. This is another one I want to hit to. New York bank regulator is now directing banks to use blockchain analytics. This is a good signal going forward because as we start to see the bank ecosystem adopting crypto in general, of course, stablecoins are going to play into this. You'll get some bank tokens that will play into that. I'm kind of curious on a poll. Would you guys trust Tether, USDC, or a bank token? I think I know the answer to that, but let me know in the comments what you would do. Just put your favorite stablecoin in there. Maybe RLUSD, whatever it might be. Let me know. This is another thing that's kind of big, and this was a tweet we put out. This is, if you guys didn't watch our show yesterday, go back and check this. This was a good clip by Tom Lee, and he's on to something, and I would agree with that. And that is that he basically stated in this clip that banks right now have started to explore blockchain at such a level that they themselves have started to pivot into what is a tech-first company. And I think a lot of companies are in that space right now, mainly because of just AI integration that's being put into so many different companies out there. So yeah, I would have to agree with Tom. I think you're at a position right now where banks are now starting to become tech companies. And that in itself, I think, is just going to be one of those things that starts to move the vision of where crypto is going to go. Ryan Sean Adams from Bankless came in with this prediction right here. Ryan, I don't know if this is much of a prediction. I think this is kind of known, and that is US dollar stablecoins is going to drain bank accounts. This is something, as we've said for a very long time. The question is when does it happen? Do we actually get that now? And I think we do, because you're looking at now a competing landscape of exchanges. We're starting to see a lot of aggressive moves by Robinhood, Gemini after going public, Coinbase. My anticipation is we're going to start seeing even more yields paid in the DeFi ecosystem. Follow the DeFi ecosystem, because those yields will also indicate a lot of strength, because that will pull away from the traditional exchanges. And when that happens, then you've got another up level for how people that are under the age of 35 who do not trust the system, they will be in a position where they're going to start to play into this. So I would agree in that particular case. I don't know if it's much of a prediction. I think we're already here. Wow, holy moly. Okay, RLUSD wins the day. I think the guys were just messing with me to show the amount of. Okay, fine. RLUSD is your stable coin of choice. Other things I want to hit on, because we're going to be getting to Chair Powell here in a second. Just for those of you who just joined the live stream, we have a quarter basis point coming in from the Fed. We have 11, no dissension. So basically 11 governors voted for the quarter basis point. Trump's tactics apparently worked. Continue to pressure. I mean, he just seems like he's playing out an episode of The Apprentice here, He puts pressure on everybody. They're jumping around trying to get things done, and then at the end they come through and maybe they deliver something. That in itself, but the biggest news of today is that there is anticipation that Chair Powell is getting ready to come on live with the press corps and tell us that we got 2 more rate cuts that are in store for this year. What would that do to the markets, guys? What would that do to the markets if you saw that happen right here on PBN of Chair Powell saying, yeah, we think the market is going to be allowing 2 more rate cuts, and then we're going to step back and look at it? At that point, what would you do? Where do you think the market would be? If you look at Bitcoin, it's still holding somewhat sideways right now. ETH holding at 44.81, somewhat sideways right now. These are the 5-minute charts out there. So definitely one. Philip says that we are going to get another flush out and then on longs before it goes up. So I don't know, Philip. I mean, there are some opportunities here, but that could be crazy going forward. The iCommando says that article is hot air. FOMC meeting hasn't happened yet. Well, yeah, the FOMC meeting has happened. They actually meet and make these decisions, and then they announce it to the press. And that's what Chair Powell is going to do here in a few minutes. In 7 minutes, we will be live with Mr. Powell going forward on all of this. And of course, that will start to move things to the next level. And that, of course, is going to be whether or not we start to see other parts of the economy and other parts of crypto starting to move with this market. Do we have the TikTok clip? Yeah, okay, let's play that real quick. So I want to comment on this because this is a big news if you guys didn't hear TikTok. Well, let me play the clip for you and then we'll go into it.
And the TikTok deal could be a blueprint for how we can thaw those tense relationships. Maybe, like to your point, China's holding on to a pun intended chip by doing what they're doing to restrict some of the chips from NVIDIA. So we shall see. But I do think that
It's like it's all on the bargaining table.
exactly. That's exactly where we are. Ultimately, I think this administration is very deal-oriented and wants to see a deal on the table. I think we are seeing indications of that just by virtue of what's happening with TikTok. And I do believe that there will be some easing. And I think once those details come out from the TikTok deal, what we will see is that it's an opportunity for a little bit of face saving as well.
Yeah.
All right, so there's a lot to be decided on this deal. It is an issue, though, in the sense that maybe it was used as a negotiating ploy in some way for tariffs. Could have been done with other deals that are being done around NVIDIA and how those chips play out within China right now. I mean, right now, listen, this is definitely a lot of chess moves being made by all of these major nations that are trying to figure out this next step up into technology. Guys, I'm telling you, we are in a very interesting time. Whether you compile not only AI, but also what's happening with blockchain and the advancements of all this tech, and the fact that we've got government regulation now somewhat favoring all of this, this is very, very bullish. And these rate cuts, and I granted, yes, we have inflation. Yes, we're going to have to deal with that, but markets will correct. And I anticipate that these rate cuts will help businesses start putting people back to work. And that's the key thing that Trump will try to claim victory on, is putting people back to work. Mark my word, mark it right here on September 17th on this live, that he's going to be looking at by Q1 the ability to start claiming victory around getting jobs back. And if that is the case, he's going to be going into a midterm that is going to really start to put a lot of pressure on that. Here's Eleanor Terrett. Remember, this is interesting. Remember, the White House voted not to include the anti-CBDC bill in Clarity Act in July in favor of putting it on the defense spending bill instead. And now they just voted to retroactively combine it back to the Clarity Act before sending it over to the Senate. Remember, this got adjusted here. So we've got a big deal happening right now in D.C. I asked a couple of Hill sources if this is a big deal. Broad response was, doesn't change anything as Senate is working on it. Don't trust them, Eleanor. Which bill will include anti-CBDC language anyway. Hopefully that will stay on point. Be careful how that goes. French Hill basically said by combining both measures and sending them to the Senate, the House continues to advance both priorities. We stand ready to work with Chair Scott and Lummis on a pathway forward to get both provisions signed into law. If that is the case, that will be more bullishness around the crypto market and blockchain in general. If we get Clarity Act through, guys, I don't know what else could happen that would be more bullish than that. Now, granted, yes, inflation will be a problem, but that's good for risk assets. You've got to look at de-dollarization. That is real. It's happening right now. So why are you not investing in digital assets? Why would you not go that route? And if you're saying, well, that's just too risky, well, then invest in gold or silver. But get away from the U.S. dollar and trying to keep up with inflation. It just doesn't work. Other things, Jerome, might surprise everyone. Murad, okay, you must have joined late. We got a quarter basis point, so we're good there. The question is whether or not he's going to give us 2 more this year. So if you are brand new to the live stream, a quarter basis point, 0.25, is the rate cut right now. This is the Fed funds rate. This will start to take some interesting scenarios into the market because real estate could get affected on this. And when I see by that, because a quarter basis point, you might say, hey, that's not really going to move interest rates. Think about this, guys. Banks will be jockeying for position. They will start looking at ways to lever up on giving a lower interest rate on mortgage deals, even though the Fed funds rate isn't there just yet, but they know it's coming. That is a factor that has been done in banking for a very long time. And if you see an early banking move that says they're dropping mortgage rates or car loan rates, then you know that you're going to start to see a little bit of softness in the market. And of course, that goes back to the point I'm getting at, which is get ready for a big move forward. And that's the thing right now that I'm looking at. A couple other things on how many cuts this year. Looks like it could be 3. We will find out here in a minute. And if we're lucky, if we get 2 more, the real question will be December. He may skip a month. So be on the lookout for that. We'll cover that throughout the month because there's going to be a lot to talk about there because there is a ton going forward. I saw something come in, should we take profit? All right, first of all, not financial advice, but anything that I would do right now, I'd wait in my position. I'm looking at mid-October. Would there be some options and some opportunities to dollar cost average out of certain assets? And if you're really bullish toward an altcoin run, then maybe factoring into those altcoins would be an option to go in that direction. But right now, I think it's a little bit too early. It's a good thing. I mean, obviously, ETH has not hit its stride just yet. I think Solana is going to go to 300. I think XRP is going to see a big run here at the end of the year. And I think we're going to see Ethereum and probably SWI and a handful of other tokens make some pretty serious runs going forward. Pradeep says ETH versus Sol. Right now, as we trade today, I would probably pick Solana only just because of where I think it will be in the short term. Now, long term, ETH might be a better play if you're a big proponent of how ETH is as an asset in general, meaning a long-term asset that could be 2 to 3 years. Here's Chair Powell. Let's get ready to cut to this live. All right, guys, here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick quick follow. I'm sorry. Can you, you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point. And we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers, and at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting. And now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months, and it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion...
All right, so there's a lot happening here on what he's doing in terms... He's waffling both ways in terms of these rate cuts. We'll talk about this in a minute as he tries to get himself out of more, grave digging, which is what I think he's doing. It's terrible. Let's take a look.
When the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, What would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just, everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. The black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 1/4 percentage point now is going to arrest that?
Well, I didn't say that I thought a 1/4 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point. And that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
You know, housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's what we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices, so that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right, guys, so a lot happening here. I'm getting some audio there. Okay, so we'll break this down for you in detail on coming shows, but just some reports. In case you came in late, it's a quarter basis point cut right now. The likelihood is that there is some pressure from current Fed governors that we could see more rate cuts coming. Of course, Powell was I feel like he was a little bit more dovish, or hawkish, I should say, around whether or not we're going to get the rate cuts this year. But the big key is they are facing a big issue right now between both inflation and jobs. We've been saying this all along. He's in a rock and a hard place. I don't know that he gets out of this. The other thing I think that plays into this right now is more pressure from Trump. Whether or not Trump will go at him as hard, or if he feels like, okay, we got a quarter basis points, we're on our way to getting corrected as Powell goes into the end of his term, which is in May of next year. So this is going to break down, I think, into a lot of situations on the charts. My guess is that we are going to, and I shouldn't say guess, where I feel that the market is going to be heading is most likely in a bullish position right now. If you look at the 4-hour on almost everything, I'll just go to XRP going sideways on the 4, BNB is on a breakout, Solana's on a breakout. Let's see if Cardano's on a little bit of a breakout. SWI was on a move right there. So you can see some of the market is not necessarily looking at this as a bad thing. So I think the real question is how much pressure does the rest of the Fed governors put on Powell to go ahead for an additional rate cut in the upcoming meetings? My guess is we will see more rising inflation. That's going to make it hard. And we're going to see even worse job numbers. That will probably offset it going forward. So there is a lot to unpack here. The good thing is markets did not crash. Markets did not boom. That tells me that investors are a little bit more numb to it and are probably waiting to see how this plays out. Remember, we have Clarity Act coming through this fall, more regulation. We also have, I think, a lot playing around international and global macro scenarios that will continue to push in this direction. And this is the first move by the United States in reference to a rate cut since last year. So very, very good, I think, at least direction going forward. But again, I feel like the Fed is and was late. They're trying to correct. Whether or not they can catch up is the real critical point. And when you look about it right now, I think the scenario right now, bullish at 61, 62%. I think when you look at it right now, the real question mark is how do businesses respond? So I'm going to be watching retail sales like a hawk going into the fall because that will give us a little bit of indicator. Credit is already in a basically shambles, and I'm talking about retail credit. That is a problem going into the kind of scenario we're facing right now because it could stimulate recession concerns. And this goes back to my whole theory on haves versus the haves. So this market is different. It feels very unique in the way of these cycles. Granted, there are cycles that could push us into movement around the end of the year. And I think toward the end of the year, that is when we are going to have to make some very hard decisions on what you're holding in your portfolios and how you're going to manage whether you're going to stay in it for the long term or you're going to start to dollar cost average out of portfolios and into more other assets and diversify. All of that we'll break down for you. We're going to get to all of that for you guys this week. We got a lot coming in terms of additional interviews. We'll, of course, be doing these additional lives when we do these big FOMC. If you like these, if you like the live streams, just let me know in the comments. That's all you have to do. And make sure and hit like on the video if you do like the live stream. That's the bare minimum. Last thing is that right now, if you're not subscribed, get in on the Diamond Circle. That is my private group that I send out an email to each week. It's called the Bear Market Edge. And basically, I break down a lot of what's happening in the market. Also play a little bit of where I'm going in the markets in general. So get in. It's absolutely free. We leave a link down below. And of course, follow me out there on X at Paul Barron. We'll catch you next time right here on The Paul Barron Show.